Welcome to Early Age Club. We are a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. We are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
So today we are going to take a deep dive into Windlas Biotech Ltd. Windlas Biotech is a leading pharmaceutical CDMO player in India, specializing in generic formulations with a mission to deliver high quality, affordable and accessible healthcare solutions. The company operates across three verticals: generic formulation CDMO, trade generics and OTC, and exports, serving 7 of India's top 10 pharma companies and exporting to emerging markets. With 5 WHO GMP compliant plants and advanced R&D capabilities and a rapidly expanding product portfolio across solid, liquid, and injectable dosage forms, Windlas is strategically positioning itself in the high-margin chronic therapies. The revenue breakup of the company is as follows. Trade generics and OTC contribute 23% of the revenue, CDMO contributes 73% of the revenue, and exports contribute 4% of the revenue. Now, their portfolio bifurcation is as follows. Chronic and subchronic products contributes 57% of the total revenue, and acute products contribute 41% of the revenue. Also, conventional products contribute 33% and complex generics contribute 67%. So the company is highly focused on the specialty segment of medicines. Now, coming to the company's presence in the pharma value chain, as we can see in the innovator value chain, the company is present in the marketing side of it after the patent expiry. Also in the generic value chain, the company is into generic API development and manufacturing, formulation development and manufacturing, clinical 3+, packaging and marketing. As the company mentions that it is present in all segments of generics value chain, and their primary focus is on formulation development, manufacturing and marketing. Also, the company is investing in creating their own formulation technology for their products, and almost 100% of the CDMO supplies are based on products where the company owns the entire IP from initiation to regulatory permission. The company has got a very vibrant and experienced board of directors with multi-years of experience, and they've also got a very good management team to complement that. Now, the key highlights of the company is as follows. They put on a ninth straight quarter of record revenues, and this quarter they made around 203 crores. The revenue numbers in FY25 was as 760 crores and with a year-on-year growth of 20%. EBITDA was 94 crores with a year-on-year growth of 20%. The company has reduced their working capital days, and their CFO has also improved, complemented by high return ratios and strong liquidity. Now, coming to their annual performance highlights, they have shown 20% EBITDA and EBITDA growth with 12% EBITDA margins, and their generic formulation CDMO segment grew by 15% in terms of revenue. Trade generics took a big jump of 41% year-on-year growth, and exports also grew by 19%, showing strong growth along all three verticals. Now, the vertical breakup we already discussed in revenue breakup. The vertical overview as follows. So, generic formulation CDMO. So, there 99% of the intellectual property rights is owned by Windlas, and their contribution as a percentage of total revenue have been declining over the years as the company has been increasing focus on trade generics and institutional medicines. So there they generally sell to the distributors and non-medical representatives, and these products are drugs for which patents have been expired and are typically used as substitute to branded expensive generic medicines. So their contribution has a total revenue have been increasing over the years, and now it stands at 23% of total revenue. Also, the company has been engaged in identifying high growth opportunities in semi regulated international markets and selected regulated markets. And their motive is to develop and register product applications in order to obtain marketing authorization for medicine and healthcare supplements. So, their contribution as a percentage of revenue have been quite stagnant over the years. However, the numbers have been growing year on year. Now they have got 757 customers as of now, with 5,582 brand ownerships with customers, and they're among the leading domestic generic formulation CDMO in India with 99% intellectual property rights. Now, the company has mentioned that their CDMO revenues are growing quite drastically, and as we can see, it was 20 to 88 crores in FY 2020. From there, they almost doubled to 555 in FY 25. Same has been for the generic formulations. It has been growing hugely. It went 5x from 2020 to 2025, and this has been made through value chain of end-to-end services, starting from product discovery and development, licensing, and contract manufacturing. They have got a large marquee customer base where they have streamlined their client acquisition process, starting from lead identification to proposal creation, negotiation, contract winning, and then client management. The company has added 757 clients as of now, and the number has been growing year on year at a very drastic pace with a 40% plus CAGR in the last 5 years. So the key highlight of the company are as follows. So they have got a strong, exclusive, and long-standing relationship with leading pharmaceutical companies, and we already discussed that they serve for 7 of the top 10 companies in India, and out of top 20, they serve around 15 top pharmaceutical formulation companies. They're trying to de-risk the customer concentration, and they're trying to achieve it by increasing their economies of scale and and they're planning capex as well as strengthening their purchasing power for raw materials. Also, we can see that they have been continuously reducing highest customer contribution. It came down from 11.7% in 2020 to 6.1% in 2025. Also, the top 10 customers contribution have also drastically reduced over the past 5 years to 34.4% in 2025. Now, regarding the domestic trade generics and institutional business overview, so entire brand ownership is with Windlas, and their products are focused on respiratory, anti-diabetic, gastroenterology, and other chronic plus subchronic TAs. So they have got 400 brands under the trade generics and institutional business head. And they're trying to leverage this by means of low cost compared to other generics and similar quality. And they are trying to access the rural areas which are less privileged to access the healthcare facilities. And also government push for schemes such as Jan are encouraging trade generics use, and we can see they are the fastest growing SBV in the last 3 years, and the number of brands have also been growing at 26% over the past few years. So all of these are very good news for the company. Coming to that export business overview, so they're focused on emerging and semi-regulated markets, which we already discussed. They own all the brands and end user customer brands. They exported 80 products during FY25, which includes generic medicines and health supplements. And their export SBV is around 33 crores as of FY25. The company enjoys robust R&D capabilities, which helps them in customizing and market complex generic products to customers and differentiate from competition. As you can see, they have been consistently doing heavy capex in R&D expenditure. Also, their R&D, they have got DSIR approved state-of-the-art R&D facilities with significant experience in multi-drug products development, and they're also focusing on low-cost, first-to-launch generic products. The company shares with us that they're leading to new innovations. They're planning to launch medicated chewing gums of multivitamins, chocolate flavors chewable tablets, disposable tablets, sustained release products, and novel formulations of existing molecules. And They have got robust growth in the complex generics. We can see the number went up from 725 in 2020 to 4,340 in 2025, showing robust growth in the number of variations in complex generics. Now, the company has got a very competent manufacturing facilities. They have got two plants in there, five plants in Dehradun, and they have been consistently adding capacity over the years. And so total installed operating capacity per year per annum has grown in the tablets and capsule segment to 8,522 million from 7,322 million last year, and the pouch and sachet has remained same at 54 million packs, and capacity utilizations have improved from 59% last year to 63% in FY25. Now, the financial snapshot, which we already discussed, revenue grew 18%, EBITDA grew 23%, PAT showed a very significant growth of 30%, which is quite good. And the margins, PAT margin, so the margins have declined a bit, and so has the EBITDA has been constant, but the PAT has declined a bit. But the EPS year on year has been growing well, so that's good. Also, their turnover ratios are decent. The ROC is quite high. ROE is also very high, and the net worth has increased over the years. And the net debt to equity ratio is it's quite good. In fact, it's I think they're debt free now. Yeah, they're debt free now, and net debt to EBITDA is at 0.1. Now, the company strategies and way forward, we are going to discuss it in the coming slides. So, coming to the industry overview, so the global pharmaceutical market is projected to grow from USD 1.77 trillion in 2025 to 3.3 trillion by 2034 at a CAGR of 6.15%. India remains the third largest pharmaceutical producer globally by volume, exporting to nearly 200 countries, and the India's CDMO market is projected to grow from USD 7.9 billion in 2024 to USD 15.4 billion by 2033 at a 7.7% CAGR. India is gaining global CDMO contracts under the China Plus One strategy due to its cost and quality advantages. India's pharma production is 77% formulations and 23% bulk drugs, which are APIs. And India's trade generics market is forecasted to grow from 24,000 crore in 2023 to 68,000 crores by 2030. Pharmaceutical exports in India also rose by 9.67% year on year to USD 27 billions in FY24, with robust demand from USA, UK, South Africa, Brazil, and Belgium. Now, to the Concall highlights. So oral solid utilization reached 60 to 62% in FY25 and is capable of 800 crore revenue from existing capacity. And Plan 6 is expected to commercialize in FY26, taking total oral solid capacity to support 1000 crores worth of revenue. Injectable capacities aim to generate 90 crores revenue at an optimal utilizations, and also the margins were impacted by new depreciation and Uttarakhand wage hikes, but they remain steady as we already discussed. Also, margin expansion is expected in the coming years as injectables ramp up and fixed cost gets absorbed. Also, the CDMO and trade generics is expected to grow well, and CDMO is expected to remain 70 to 75% of injectable scales sales. Export is expected to scale gradually with steady dossier filings and approvals abroad. And trade generics has grown approximately 3x in 3 years, which we already mentioned. And the management aims to scale towards peers like Cipla and Alchem. Right now, trade generics is around 200 crores of their revenue, and for Cipla and Alchem, it's around 2000 crores. So they are around 10x bigger than Windlas, but they're trying to scale and reach to their levels. Also, the management is evaluating inorganic opportunities for dosage form expansion, but they also have got a backup plan in organic capex after the injectables ramp up actually takes place. Coming to the bull case scenario, CDMO vertical continues strong double-digit growth with deeper client penetration and doses from diversification. Also, Plan 6 expansion will boost oral solid capacity, enabling revenue scalability to 1000 plus crores, and export vertical accelerates with increased dossier filings, approvals, and entry into semi-regulated markets. The government-led initiatives like Jan Aushadhi significantly scales the trade generics demand in tier 2, tier 3 towns, and R&D innovations and first to launch complex generics can establish Windlas as a value accretive IP holder. Regarding the bear case scenario, delay in capacity utilization at injectables or slower than expected commercialization can impact the margins. Increased competition in generics and CDMO space can compress operational margins, and export momentum might slow down due to geopolitical or regulatory challenges in global markets. Also, delay or failure in M&A or organic diversification efforts may lead to strategic stagnation and capital inefficiency. Coming to the 20 factor scorecard, they came up with the IPO in 2021, which was a IPO of 401 crores in total, out of which 165 crores were fresh and 236 crores were OFS. They used the 165 crores in capacity expansion with 50 crores, working capital requirements worth 47.5 crores, repayment of borrowings worth 20 crores, and general corporate purposes of 35 crores. So it was highly invested in repaying debt and funding working capital. Also, there was a OFS component, so I gave them a 3 here. Now they've got a very robust management team, which we already discussed. Windlas family holds 62% of the company, so I give them a 5 here since the company's management is good. Related party transactions are pretty minor. There are minor rent and commission transactions with promoters and other minor transactions with related parties. Nothing significant to note. So I gave them a 5 here. Regarding board independence and composition, here there's a bottleneck. So they've got 8 directors, out of which 3 are independent directors and 4 are family members or board. So there is higher family control. On account of this, I'm going to pessimistically rate them a 3 out of 5 here. Regarding CEO key managerial personnel salary, it's quite less. It's around 0.21 and 28% of revenue. So I gave them a 5 here. Key person resignations are none, which is quite good for a company. The employees are strongly held, so I give them a 5 here. Regarding auditor resignation, the old auditor served for 10 years and the new auditor has that tenure till 2030, who got appointed this year itself. So I gave them a 5 here. Auditor opinion has been unmodified over the years. Credit opinion has been very positive. They got a IKRA A plus rating for long term and A1 rating for short term. So I give them a 5 here. Regarding regulatory or legal issue, in 2020, FDA gave them a notice for violation of compliance standards in their Dehradun plant. On account of this, I'm going to pessimistically rate them 3 out of 5. Regarding investor communication and disclosures, all of it is available, starting from presentation, con call to results. So I give them a 5 here. Now, the company has got significantly less business concentration risk. The company has been consistently deleverage the concentration from top 1 and top 10 customers, and it's quite good now. Also, the number of CDMO customers are around 757 now, and the product in offerings increased to 5,582. So, on account of this, I'm going to give them a 5 here. Regarding CFO by EBITDA, so CFO by EBITDA is good actually over the past few years. However, this year it's around 61%. This happened because of higher receivables balance, which is also balanced by higher payables, but there's an increase in inventory. So on account of that, I'm going to give them a 5 here. Regarding revenue growth versus receivables, so receivable as a percentage of revenue is around 22%, which is slightly on the higher side. Still, the revenue growth is robust. So on account of that, I'm going to give them a 5 here. Regarding inventory trends, inventory days are just 52, which is nice. Inventory is growing very high, but the inventory as a percentage of revenue is decreasing over the years. So the company is quickly converting their inventory into sales. So that's a good sign. So I give them a 5 here. Cash conversion cycle is good. Cash conversion cycle is just 17 and it has declined severely over the past 3 or 4 years, which is very good for the company. So I give them a 5 here. Capex as a percentage of revenue is quite good. They have been consistently investing in R&D. Fixed asset turnover and asset turnover is also good. And return on investors capital is also quite high. So I give them a 5 here. Debt and interest coverage is good. They're almost debt free and interest coverage is around 20 times. So I give them a 5 here. Liquidity position, on the other hand, has been declining over the past few years. This has happened on account of high inventory conversion as well as lower cash balances. So I'm going to pessimistically rate them a 3 out of 5 here. However, it's not a very negative sign. Regarding ROCE and ROE, it's growing and it's quite good. ROE has also been good, so I give them a 5 here. Regarding growth consistency, the company has been consistently growing at a pretty good pace in the last 3 years, and the PAT growth has been quite good. There has been a small dip because of the margins have dipped this year. However, the company is showing strong growth, so I give them a 5 here. Now, coming to the total score, the company scored 44 out of 50 in governance and promoter behavior and 48 out of 50 in financial health, taking their total score to 92 out of 100. Now, coming to the valuation analysis. So, overall, an interesting company, very good score. The stock has been also re-rated in the since the listing period and currently trading at a PE of 50.34, and debt is low. They have investment and the new capex also coming on the injectable plant. One thing is the operating margin is pretty low compared to a lot of pharma companies that I've noticed. Generally, they are upwards of 20 minimum. And second, the cash conversion cycle is again extremely low, which is good. Maybe they're doing something with the cash conversion cycle, giving payables late and collecting sooner and with a lesser margin could be one of the reasons, because generally pharma cash conversion cycles are upwards of 50, 60 plus. Yeah. But anyway, considering that the trend continues and new capex comes into play, let's just be conservative and take the worst case. And yeah, the margins are pretty constant. And consider if the PE is 25, the price target is 800. Currently, it's trading at 991. And even in the best case scenario, the price target comes to 1000, considering the PE of 26. So most of the re-rating is going to be from price to earnings rating and not from the sales growth, because management is guiding for 20% growth year on year. But considering a long frame of 5 years, this is free cash flow. Since they've done heavy capex, it's a smaller number. Let's try taking, let's see, operating cash flow 8 and their net profit is 61. So let's take a lower number of 60. Discount rate, minimum rate of return as 20, and terminal growth rate of 3 and 5 years. And since it's a pharma company, it generally trades between 20 to 25, but let's see what 25. So the implied growth rate has to be 26 for you to realize a 20% return. But then if the PE is 25, then the implied growth rate is 21. So yeah, the company is growing at 20% CAGR. If you increase the time frame a bit more, then your probability increases, because then the implied growth rate comes down to 19.4. And if the company continues to deliver, then this is realizable. Yeah, do look into the risk. There are a few risks in the pharma sector, but overall they are consistent compounding businesses.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching, and we will see you in the next one. Bye-bye.